We celebrate this evening the 20th anniversary of this program. Yes, 20 years ago, this program began. Over the 20 years, there have been no guests that have been more interesting or more eagerly anticipated than Warren Buffett. His is a fascinating story. His is a name that is known throughout the world for his extraordinary success as an investor and the parallel success of his company, Berkshire Hathaway. He has been in the news recently because he made a major investment in Bank of America. He also announced a stock buyback of Berkshire Hathaway shares. Perhaps the sharpest focus recently has been on his announcement that wealthy people should pay more taxes. President Obama was certainly listening because he included it in his list of tax law recommendations. He called it the Buffett rule. Warren Buffett is in New York, and we're pleased to have him at this table, not only because he's been such a wonderful guest for us, but also because he is a friend of mine. Welcome.
Thank you, Charlie.
You've announced recently you're going to buy back, or have started the process of buying back Berkshire Hathaway shares. Some people were surprised because you had written in your stockholders letter, which is now famous, I don't do that.
Well, I haven't said that. I said I have said that you should buy back your shares only when you think they're selling at a discount to their intrinsic value.
Right.
And since intrinsic value is not a precise figure, it's a guess.
But part of the reason you said that was because you don't necessarily think that people who buy back shares simply to improve the stock performance.
Sometimes they're trying to prop their stock. Right. Sometimes they're, who knows what their motivations are. There's only one motivation for me. If I think I'm buying our businesses at a discount, I think then it helps all the shareholders. Now, I also think you should tell the people before you do that, just like if you're my partner and I want to buy, you want to sell out. If I think I'm buying it from you too cheap, I ought to tell you that. Now, with the stock exchange, it sets the price, and every now and then, it happened about 10 or 11 years ago, I thought Berkshire Hathaway stock was selling demonstrably below the value of its businesses. And we announced we were going possibly to do it 10 or 11 years ago, and then the stock went up right away, and we couldn't do it. But this time, if the market is weak, we could buy a lot of stock. But what I say is we'll buy the stock if we think we're doing a favor for the people that are staying in the boat.
Because you think the intrinsic value of your businesses, those that make up Berkshire Hathaway, is undervalued.
It's higher than the price. Yeah. It's clearly higher than the price. I mean, it's not a precise figure, but it's clearly higher than the price.
You offered book value plus 10%.
I said that's the limit of what we will pay.
Yeah.
So the market will determine what we pay. Yeah. So I mean, if the market tanked, next week we'll say, Berkshire could be a lot cheaper than that, and I'm not propping the price in any way, but I'm just setting the outer limits of what we will pay, because above that, I probably still think it's cheap, but I want to be demonstrably cheap. I want to be doing the shareholders a favor by buying the shareholders will remain a favor by buying in the stock that they're getting there.
So you have what, $47 to $50 billion of cash?
It's down some. We've spent some, Charlie, but we got plenty of cash. We'll put it that way.
But is there a limit of how much you always want to have in reserve in case an incredible opportunity comes up and you can go do it?
Yeah, we won't go below $20 billion in consolidated cash. Yeah.
So you could be prepared to spend more than $20 billion to buy back your stock.
We can spend a lot of money depending on over how long a period, because we're earning money all the time, and as we earn money, the money comes in, and there's no time limit on it. There's no dollar amount limit on it. There is this limit in terms of valuation, and there is this limit in terms of maintaining a given level of cash.
It is said that some people think that the asset value of Berkshire Hathaway is close to $130 to $150 a share for the Class A stock.
Yeah, I hope it's 130,000.
No, I mean 130,000. No, of course, 130. Of course, I meant 130,000. Right.
I don't know what the number is. Yeah. I know it's more than 110% of book. I mean, we've got some wonderful businesses. We've got some that aren't so wonderful, but with some of the big ones, particularly, are really very, very good businesses, and they're worth a lot more than they were when we bought them.
So why don't you sell those that are not so wonderful?
I just don't do it. I don't do it. If I have 10 kids, one of them's a little slow, I'm not going to put them up for adoption.
So that's the way you feel about these businesses?
Yeah, I do, unless they promise to have permanent losses over time, or unless they have major labor problems. And I put that in my annual report for, 30 years. People come to me to sell their business to me. They work hard for me after they sell their businesses. Everything doesn't work out perfectly in life, and I'm not about to dump somebody because it's subpar. If it's a disaster, we have to get out of it.
This is a signal from the sage of Omaha that there are not a lot of investment opportunities out there.
Well, both statements are wrong. we got the paperwork cleared. I guess just yesterday morning.
So the process has begun.
So we actually bought some shares. Now,
right.
Whether we buy a lot of shares or not will depend on the price. I mean, but we intend to buy shares if the parameters we laid out are correct. It has nothing to do with what, you know. If I live to be 100 and keep my marbles, I hope I'm still around.
Well, in fact, in the last quarter, didn't you spend about $4 billion on stock, common stock?
September 30th being the current quarter.
Right,
the third quarter we
right.
spent a net of $4 billion, roughly.
And have spent about $8 billion so far this year in terms
That's
of
about
buying
right.
common stock.
That's almost exactly right.
Which suggests you're buying stock because you believe in America and you believe in these companies and you believe...
They are American companies. They do business... a fair amount abroad, but they are American companies. And incidentally, we're investing $7 billion.
I was going to make that point.
Yeah,
in terms of infrastructure and...
Sure. And when we buy stock, our own stock back, we're intensifying our interest in a whole bunch of mostly American companies. Our shareholders will own a greater percentage of BNSF, Burlington Northern. They'll own a greater percentage of Geico if we buy back shares. The pie will be as big, but there won't be as many slices.
Here is what George Soros told CNBC last week, that he said, rather than the U.S. slipping into recession sometimes in the future, I think we are already in it. Michael Spence and Paul Krugman said there were 50% chance of another recession. Yeah. You don't buy that.
I don't buy it. But, I'm looking at 70-some companies, and I will tell you that our railroad carried 193,000 cars last week, and I can tell you in terms of candy sales and jewelry sales, we got 3 different jewelry operations, 4 different furniture operations.
They're all up.
Yeah, they're not galloping, but there has been no downturn. There has been no downturn, and except, as I've told you before, home construction is flat on its rear.
When is it going to turn around?
It's going to turn around when we've created enough more households than houses that the inventory of houses gets down to
But is there a magical way to do that, to create more inventory than...
Well, the way to do it is to hold down creation of new houses. I mean, we have got about 500,000 plus housing starts going on. That counts apartments as well.
So the way to do it is stop the supply and limit the supply.
If we create more households than houses, we will bring the inventory into balance. I don't know when, but we did just the opposite 6 or 7 years ago. We created more houses than households. Surprise, we had too many houses. And it is really a question of supply and demand, and we created too many houses relative to households. A few years back now, we're creating more households every day than we are houses, and we will come back into balance. And I don't know when that will be, but when it happens, and when we get back to 1 million units a year, something like that, I think you will see unemployment rates drop significantly.
To perhaps 7 to 6%.
Yeah.
And you will see the full economic recovery at that time.
You'll certainly see something very much closer to it.
Do you believe it will get back to where it was prior to 2008?
Well, to some extent,
both economic growth and unemployment.
we had an unsustainable binge because we were creating, among other things, too many houses and selling them to people who couldn't pay for them and all of that. So we were in the bar drinking. I'm not sure we want to go all the way back in, but we want to get over the hangover. Well, it's fun while you're doing it.
But at the same time, you recently made a significant investment in Bank of America.
Correct.
And some say that part of the reason that they are having a difficult time is because of the amount of the mortgage lending that they are responsible for.
They made a lot of mistakes during the binge, as did a number of other financial institutions, including the 2 run by the federal government, the Fannie Mae and Freddie Mac. But they made mistakes. I made mistakes, and the present management is paying the price and unwinding some of the sins of a previous management, and that takes a lot of time, and it's not done yet, and it'll take them a lot of time. But that doesn't bother me. I mean, I think that's just part of business. You do some dumb things, and then you work your way out of them.
Time has been your best friend, hasn't it?
Well, time is right. I try to. Geico got in trouble in the mid-'70s. American Express got in trouble in the mid-'60s. Those are 2 of the greatest investments I've ever had, and you had to look out 5 or 10 years and say, where. And that's what you got to do with the economy, incidentally. I mean, we have a wonderful economy in the United States over time, and it will come back just like Geico came back, American Express came back. Bank of America will work its way through its troubles. It'll be painful, There'll be lots of headlines for a long time. You can't do it in 3 months or 6 months. But you've got a fellow working at it. He didn't create the problems. He's working on solving them. Yeah, Brian Moynihan, and you've got a very, very fine business underneath.
One of the arguments between Republicans and Democrats in this upcoming political battle is going to be between the balance between spending cuts, which treat deficit in part, and a growth strategy that builds towards the future. Yeah. How do you figure out where you ought to be on that?
Well, we will get growth in the future. I mean, you've got American genius of capitalism working to create growth over time. I mean, that is not primarily a function of. A lot of times they talk about growth when they mean to create inflation. Right. So I don't worry about the United States growing per capita GDP over time. We'll have periodic recessions. This was a particularly strong one because it was a particularly wild binge. I mean, it was something, and we're paying for it to a degree.
Do we need something to stimulate the economy to create growth, either on the part of the federal government or on the part of the Federal Reserve?
Well, we've been stimulating like crazy. We've been running a deficit of close to 10%, depends on the exact period, of GDP annually. That's a lot of stimulus. I mean, it doesn't make any difference what they call it a stimulus bill. It's stimulus. And we have given monetary policy, we put our foot to the floor and driven interest rates to zero and piled up reserves at the Fed.
But there's some debate within the Fed as to what might be done and where the focus ought to be.
I don't think that will be too important. I mean, the important thing was what the Fed did 3 years ago. And I mean, if they played it wrong then, we'd be paying a huge price for that. But they've used up most of their bullets. The chairman would probably disagree with me, but in my opinion, monetary policy has been played out about as far as it can, and it's been useful, but I don't think there's a lot to be done there that's going to change the course of the business recovery.
And he thinks there's few things that he can do that he still has in his group.
He's doing this Operation Twist and trying to bring down longer rates. But we've got low rates. I mean, interest rates are not the problem in the economy now, and short rates are nothing, and long rates are pretty darn cheap. So I don't think anything further in that direction is going to have a big impact on the economy.
I just talked to some Chinese business people who were in Washington to meet the Secretary of State and Secretary of Treasury, and they came to the table in Washington, and they're a bit worried about inflation in China.
Yeah. Well, but they'll have some, and they may have a lot sometime. I mean, any economy that, well, look at what we've had over the years. I mean, a dollar when I was born is worth about 6 cents now. So we've had a lot of inflation. It's something in the area of 15 for 1 since I was born. And if you'd told my dad that in 1930, I'm not sure he would have had me. I mean, he would have thought that the world will come to an end. And things have turned out pretty well. During that same period, real GDP per capita has gone up 6 for 1. So I'm against inflation. I'm for tempering inflation, but when you have a booming economy, you may well get some, and sometimes it may get out of control, and sometimes you have to do something about it. But most of these things aren't the end of the world, Charlie. I mean, we always think they're the end of the world at the time, But as I mentioned before, I mean, when I was born on August 30th, 1930, that was the high day for the Dow for the whole year, 242. Went straight down to 41. I mean, my mother must have felt guilty as hell witnessing what had happened.
Little did she know.
Yeah, but 25% unemployment, all kinds of things. This country comes back. It came back from what happened at Pearl Harbor. It comes back from all kinds of things, and it's coming back now.
So, what role would the Buffett rule play in that coming back?
Well, I think that it's very important in terms of getting people to make the kind of sacrifices they're going to face. I mean, we're going to be telling people that some of the promises have to be modified. And these are people that don't have lots of margins of safety in their own affairs. I mean, they're not like me. They don't have, you can't just sell a few stocks or something like that if the payment doesn't come through for this or that. So we're going to be asking the American public as a whole to participate in a belt tightening when we bring down expenditures from 25% of GDP or thereabouts. And I think that when you have a very, very small group of ultra-rich people who have incomes of $1 million or more, who are paying very low rates, like I am, 17% in my case, but I have a number of friends. I've talked to a lot of people in the last few months, and a number of them are below my 17%, even though they're in this Well, some of them are in this famous 400 category that averages $220-some million of income per person. I mean, that is some kind of income, isn't it?
It is plainly because they pay capital gains rates. Is that the primary reason?
That's a lot of it.
That's 15%.
Yeah, that's a big
right.
one. But dividends are 15%.
Right, exactly.
And the ultra-rich who are paying really subnormal taxes, and there's a lot of them, but there's a lot of them that aren't. Right. But there are a lot of them that are. I think I think it's a terrible mistake to ask 300 million Americans to tighten their belt and ignore that group.
Okay, but here's my point. Is it because of the economic value of doing that per se in terms of the more revenue going into the IRS, or is it because the essential fairness of the American system is an important point? If you're asking the population at large, you have to make damn sure they think that the country is operating out of a sense of fairness.
Yeah, it's both. But it's the second point I think is more important than the first point, because I would estimate there might be 20, if you put a minimum tax in, it would affect a portion of the ultra-rich who are receiving. That might raise $20 billion a year by some rough estimates I made. I don't think those are crazy estimates. Now, $20 billion a year seems like a drop in the bucket when you've got a deficit of $1 trillion or so. But $20 billion a year is still $1,000 each for 20 million families. I mean, and you got to get the revenue someplace. So one way or another, I mean, who knows how they're going to ask everybody to sacrifice. But if you have a choice between asking 20 million families to come up with another $1,000 each, or hitting 50,000 or so people who are paying very subnormal taxes on very large incomes, I say that, you know, I'd rather get that 20 billion from the people that are like me. And
when John Boehner says that the president, when he buys this idea, is practicing class warfare?
Yeah, well, the class warfare has been going on. I mean, if you look at these 400 top incomes that have gone from 40 million on average per family up to 200 million, their tax rate's gone from 29 and a fraction down to 21%. So there's been class warfare going on. It's just that my class is winning. In fact, my class isn't just winning. I mean, we're killing them. It's been a rout.
You've got everything on the board.
Well, just look at America today. I mean, in terms of the ultra-rich, I mean, they have not suffered through this. Listen, and incidentally, if somebody's making $5 or $10 million a year, $20 million, $30 million a year as a CEO, athlete, or whatever it may be, and they're paying the normal tax rate, you know, they're in the mid-30s or something like that. Yeah. I have become convinced after talking to a lot of the super rich who've talked to me about this that the best way to do it is this minimum tax, of making sure that everybody at those levels, million and over, is paying in the mid-30s.
How many people will be affected by this if you use the $1 million as the point of reference? Because is it everybody that makes more than $1 million, or is it a select group?
No. There's two ways of going at it. One is to do it by rate, in which case the whole group would be affected. There'd be about 250,000 people. Just raise the thing 5 points or something like that. And that's an acceptable way to go at it. I have talked to a lot of very rich people, and I think the fairer way of doing it is to take the people that have found ways to bring their rates down to the 15% level, or 17 in my case. Some of them I know are below 10, and just have a minimum tax for them. Now that would hit about 50,000 in my guess, and I don't have any great figures on it. It might be 70,000, it might be 40,000, but it won't be 10,000. It won't be the whole group. It might hit 50,000 out of the 250,000, and they would be brought up into the 30s in terms of their tax rate overall.
So what percentage of your income is taxed at 15% or 17%?
A lot.
Because you have some ordinary income. You pay yourself $100,000 a year or something like that.
Yeah, and I have some interest and that sort of thing. But
that's a small percentage of your income.
It depends on the year, Charlie. There've been some years. There were years, a few years back, for example, when I made a lot of money out of owning Freddie Mac and Fannie Mae mortgage pass-throughs, and I got a lot of interest income on that, but I also ended up making a very large capital gain on it. And incidentally, that money had not been taxed before at some corporate level. Well, I read these arguments about that, and it didn't apply at all. I made a lot of money off a few years back off a bunch of little Korean stocks. I may have even mentioned that to you. And, you know, those companies did not pay any U.S. income tax.
What do you think of this idea that you need to change and have tax reform? Because if you do, companies will start bringing money back in that they're withholding overseas and doing something with it overseas and not bringing it back here because they think they're double taxed.
Well, they would like to be able to repatriate money that was taxed at very low rates in some various places around the globe.
Right.
Some sort of legitimate in terms of where they manufacture, sometimes sort of artificial. And they would like to bring that back as they were allowed to do, I don't know, 5 or 6 or 7 years ago. There was a one-time repatriation. But we own stock in some of those companies, incidentally, that have got a lot of money that they would call trapped over there. Now, if they're allowed to bring it back and pay very little tax on it, where do you think they're going to want to keep earning money over there, aren't they?
So you don't think they'll bring it back?
Well, I think they'll bring it. Well, if they were allowed to do it without paying any tax to speak of, or a 5% tax, they'd bring it back. But they say that would be wonderful because we'd be bringing this money back to the United States
and investing.
But what it would mean is, it would mean, my God, we can earn a lot of money over there at 5 or 10% tax rates, and so let's keep bringing it back. We ought to keep trying to make more money over there and build more plants over there. So it cuts both ways. It is an incentive. If you come up with a low repatriation rate, it's an incentive for people to try and put more of their production and make more money abroad, because that brings down their overall tax rate.
Corporate America is sitting on a lot of cash. And they say, there are a couple of reasons for that. Number one, they say it's because of regulations, and they don't have confidence in what the tax structure is going to look like. Do you believe that?
No. I believe that they can't find good projects that they like, and that they don't see the demand for certain things. I'm not going to build more carpet mills or something like that, or more brick plants if I don't see where I'm going to sell the carpet or brick.
We're not just talking about people tied to the housing industry. We're talking about a whole lot of corporations in America are sitting on a lot of cash, and they say they don't have confidence in the future, and that's why they're doing it. And you say, what?
Well, I've got a lot of confidence. They ought to have confidence in the future. They're earning very good returns in most cases on tangible net assets. American business is doing fine, with the exception of housing.
They'd be a lot better off if they were investing money, being able to hire new people.
If they can, yeah, but they've got to find the right projects.
Yeah.
And to their credit, I would say that I don't know of any companies that see intelligent things to do with the money, whether it's here or abroad, and that have the money, that are sitting there not doing it.
Okay, so you're basically saying that the problem with the American economy right now is corporate America, which creates private jobs, is not seeing a lot of intelligent things to do with the money.
Yeah, there's a lack of demand.
But what does that say?
Well, Keynes would say it with me, but I'm not advocating this necessarily. He would say you got to stimulate a lot more, because only government can.
Paul Krugman says that too.
Yeah, right. And they may be right, but we've done a lot of that. We've already seen a lot of that. So it would have some effect in my view, but I think the efficacy of it, once you're up to stimulus of 10% of GDP to start with, I think.
Do you think the absence of that kind of demand and intelligent opportunity to spend the money is in part because of the administration that's been in charge that owns this economy now?
No, I think it's a function of coming back from a brutal blow. I mean, we talked about the patient being in the hospital. We had an incredible bubble. I mean, manifested in all kinds of ways, but focused around housing. Right. I mean, you had $22 trillion of residential housing. That's what, at the peak, houses were worth. That was a huge part of the American public's net worth, and so we had a body blow, and we are coming back from that, and we will see more things to do.
So you are saying you think, and you're supporting the president, and you're at a fundraising event here in New York because you believe he and his administration have made the right decisions for the economic growth of the country.
In general.
You see no specific example that was so egregious that you could not support the president.
That's correct. And I will tell you, Charlie, we're making rail cars. This is not BNSF. This is a company called Marmon. We make tank cars. We lease them then frequently. We're down in Alexandria, Louisiana. I think we've increased production 3 or 4 times in the last 12 months. I mean, we are employing a lot more people in Alexandria, Louisiana, building tank cars than we were a year ago. And it's been step by step. It's increasing. We're seeing it, utilization of cranes in terms of oil fields. But we see it all over
But what makes you different? Because the conventional wisdom is that most of Wall Street, which supported the president last time, is not supporting the president this time, Jamie Dimon included.
Yeah, well,
these are people who look at the economy, the same economy.
Jamie, I don't think Jamie would tell you the economy's not getting better. In fact, I think I've seen something where he specifically said.
No, he has said, and the bank's getting better, and he's happy with the bank. But,
right, but he's
not supporting the president, as far as we know.
We don't know.
but a lot of Wall Street, at least you'll accept the idea
I agree.
that a lot of people look at the same evidence and say, we don't think the stewardship's been so good, and we don't believe that the economy is as good as you do, and they think regulations and everything else is part of the mix.
Yeah, I would say this. Most of them are in businesses that are doing pretty well. They may not be doing as well as at the binge. I mean, Wall Street isn't doing as well, but you take the number of people making $1 million and over in Wall Street, and you can fill a very large auditorium.
Yeah. So they're doing well.
There are a lot of
but
people.
But they're not supporting the president, are they?
No, they are. I would. That's my impression.
Mine too.
Yeah,
I don't know.
That's my impression. And
so what happened? Why are they? Have they deserted the president?
I think there was some rhetoric that contributed to that, but
the demonizing of business.
Yeah, they felt that, and I think the president felt, I got to look at all the things we did for business, and they're unappreciative, and I'm all that stands between them and the pitchforks. And
he said that in one famous meeting.
And so Wall Street certainly doesn't feel loved, and they may like to feel loved.
But you don't find that in mainstream America, and you don't find that in Omaha, or you don't find that in...
Well, there are people, there's no question, it was Mario Cuomo that said, you campaign in poetry and you govern in prose.
Right,
and if you think about it, the whole act of campaigning is raising people's expectations, and then once you get in, you have to bring them down.
But you essentially are saying that you're not disappointed by this president for the most part.
No, I am. I agree with that statement. Yeah, I'm not disappointed. No.
Well, some you would have liked.
Oh, everybody.
You would have liked for him supported more loudly, Bo Simpson, that kind of thing.
Yeah, definitely. And listen, anytime you elect a president, you're not going to feel 100% about every single thing they do, and I'm sure that the shareholders of Berkshire do not feel 100% about everything I do. I mean, it just doesn't work that way in a country with 300 million people and strong feelings about this issue and that issue.
What about this idea that somehow if we had someone who understood business who had managerial experience in business or managerial experience at all, we would have been in a better place. The decisions would have been different.
Yeah, I think if you take the overall group of decisions, I don't agree with that. I think that, sure, a given decision might be better here or there, but I mean, the decision to make Tim Geithner Secretary of Treasury was a terrific decision. I mean, that's like when I appointed
and to talk him into staying.
Yeah, well, yeah, may have a job, but when I pick a good CEO, that's a terrific decision. I mean, then I don't have to think about that.
Is it possible that you're just different? That somehow, some way, because of your mother, because of your wife, influences on you have made you different, your own native intelligence, whatever it is.
Well, everybody's influenced by what's around them.
Ben Graham, whatever it is, that you, Warren Buffett, look at the world differently than most of the prominent businessmen in America.
Well, it may be true. I think differently than a very good number of them. But I have a lot of them that agree with me one way or another. They don't agree 100% with me. Again, I mean...
Go ahead.
Yeah, but nobody's in total sync with anybody else, even if they're twins probably. But I've heard from plenty of people who are very, very wealthy, and I've heard from others who are business people who are not that wealthy, but that in general agree with what I'm talking. They've got a similar hope for America. And there's plenty that disagree.
Two things are on the horizon. Number one is Europe.
Yeah.
You have, I think, said you're not going to be rescuing any banks over there with any kind of significant investment. You've also said if this thing goes bad, you're in great fear of what the consequences are. What did you mean?
Well, it's big. and they have tried an experiment which where the imperfections in it are becoming manifest in there, and the numbers are big. The banks are the solvency of the banks are intertwined with the solvency of sovereigns and vice versa, and they have found that while they melded into a single currency for 17 countries, they didn't meld the culture, they didn't meld fiscal policies, all kinds of things. Yeah. So they either have to come closer together in a major way, or they have to separate and
give up on the euro and give up on the eurozone.
Yeah, and they don't want to do that, and that's understandable. And there's all kinds of.
But there's also this argument: all they're doing is kicking the can down the road.
Well, they
really need to a lot more on the line, and they really need to sort of do more at one time to make sure that they have stopped.
It's a short road, Charlie. You can see the end of that road. They better not give it a good kick, or it won't be on the road anymore.
It's over the cliff, is it?
Yeah.
So what happens to us if it happens? If the worst happens, what happens to the United States? And what happens to the global economy?
I don't know what they're going to do. I mean, when you get 17 of them, nobody knows what they're going to do. And politics enter into all kinds of things. But if you ask me, the most likely thing that in the end they will decide to print money, which they've got a lot of problems doing because they do have this common currency. But when politicians face almost insuperable problems, and it looks like they can solve it by printing money, I think they will do it. I think they will, to the extent they need to, they will help the banks. But I don't know what I don't want to. That's not a prediction. That's my best guess.
Yeah. But the hour is late.
It's late. It's very late, and it's very late. Yeah, their banks were encouraged to load up with sovereign debt because there were no capital requirements against them, and it gave them the chance to leverage further and increase the earnings per share a little bit, so they just loaded up with them. And they thought that they were all good credits because they all belonged to this union, and they're finding out that isn't true.
What did you see a year or so ago when you got out of European sovereign debt?
I saw where the can was going. No, I really did.
But I mean, did you see it and other people didn't see it?
Well, no, I think people
saw it, but didn't.
It's a little like our own situation back in 2006 and 7. Everybody sort of saw it, but you kind of thought, well...
Well, I don't know that they all saw it, but I don't think they understood it. I mean, I think part of the problem was that these people didn't understand it. You mean the subprime crisis? Well, you think I'm wrong about that? They saw it?
I think people had kind of an uneasy feeling, a lot of people, but they thought, they were like Cinderella at the ball. I mean,
that was the analogy they used, you remember? Yeah. Citibank executive said, as long as the music playing, you have to keep dancing.
Right.
That was the classic.
That's right, and he probably thought it was all going to turn to pumpkins and mice at midnight, but he didn't think it was midnight, and he thought he'd get out ahead of time. I mean, he's not the only one.
There was a lot of that. And
listen, I made a lot of mistakes in that respect. I mean, and I saw certain things taking place, but I didn't take strong enough action in many cases. I'm as guilty as anybody. But in terms of Europe, I think it was clear well over a year ago that we were heading for a cliff. I mean, you just can't have people tied to a given currency who have lost the ability to print money behaving recklessly. It's going to come home to roost very quickly. And when those bonds of those countries are held in huge extent, it's a bad situation. So on the other hand, it won't end the world, Charlie. Europe isn't going to go away. Europe will be stronger 10 years from now for sure than it is now. I don't know how much agony it's going to go through in between. It'll be a great market for goods. There'll be great.
But is the answer austerity?
I don't know.
That's the question.
I mean, it's always great to say the other guy should get austere. I mean, that's the problem they have. It isn't a common austerity. It's your austerity will take care of my bonds.
The Germans have a point, don't they?
Yeah, sure they have a point. Sure they have a point. Sure they have a point.
People are beginning to say maybe a flat tax is not such a bad idea.
A flat tax is that is not progressive. No. I mean, you're going to have to raise some more revenue than we're raising now. I mean, we're going to have to bring it up to 18% of GDP or 18.5%, and we're going to have to bring spending down.
Then why don't you convince the president to lay out what he would do in terms of entitlement?
Charlie, I've never called the president in my life.
You've never called him?
No.
But he calls you up and asks you to come and he solicits your advice. I mean, you come to that White House because he wants to hear what you have to say, I assume. He doesn't bring you there to tell you what he thinks. He wants to know what you think.
He wants to give me a new tie, actually. But
wouldn't it have been better if he'd laid out for the political discourse in Washington, if he'd laid out where he thought cuts would be appropriate?
Well, looking back, but this is easy to do.
Yeah, I know.
You can do it in the stock market all the time. But looking back, he probably should have prepared the American public somewhat better for what lay ahead. I mean, there was not going to be some magic wand when he came in 2009, and he did a lot of very correct things. I mean, I admire him enormously in the actions taken, but to the extent that people thought that was going to cure everything in 6 months or 8 months or 10 months, I mean, that was a mistake.
As you know, Standard & Poor's downgraded their evaluation of America mainly because of political dysfunction.
Right.
That is at least what they said. Do you know how we stop this political dysfunction?
Well, that's the $64 question. I mean, we've got too many people in Washington, and the American public understands this, who are thinking primarily about, how do we block the other guy from looking good, and I want them both to look good. I want a government that looks good, and there's always been a lot of that, but I think it's just extraordinary, and the debt ceiling situation, just played it out in Technicolor and stereophonic sound for the American public, and the American public feels that Washington just is in some ways dysfunctional because they want it to be dysfunctional, and
because they think they win by dysfunctionality.
Well, if you can be in either party and convince the American public who are not feeling good about how their country is going, you can convince them it's the other guy's fault. I mean, that's
but you
the way
think
to
the
win.
American public would rebel against that if they could find out who they thought showed the least regard for their own sense of well-being?
I would really hope so, and I think there's a possibility of that. But how this all plays out, I mean, I think that there are plenty of people in both parties. This is not limited to one party who are thinking that things are going to look bad over the next 12 months, at least perceived as bad, and the unemployment rate won't fall that much and so on. And I think they think, how do we lay this on the other guy's doorstep?
So therefore, I will not vote for something that might improve the economy of the country because I don't want to see the other guy do well.
Well, it may not be quite that dramatic, but it's that impression. And I think that's why people have the feeling about Washington. They do.
But the problem is that they may very well be saying a plague on both your houses. They're certainly saying that about Congress.
Yeah, I think they feel that way about Congress, and I think they've probably got pretty good reason to feel that way about Congress.
You think we need a third party?
Well, I just don't know how that works.
It's great to see you.
It's great to be here.
Have you here.
Thanks, Charlie, and another 20 years to you.